All right, welcome back. Today we are diving deep into LifeVantage Corporation. That's ticker LFVN. We're going to unpack their latest earnings call, look at the numbers, and really try to figure out what's going on with this company and where it might be headed.
So here's how we're going to break it all down. First, we'll hit the headlines, how they did versus what the street expected. Then we'll get into the story management is telling. After that, we'll look at how the market's actually reacting to all this. Spoiler alert, they're not buying it. And finally, we'll give you our take on what to watch for.
All right, section 1, let's jump right into the numbers.
Okay, so right off the bat, you can see it's a bit of a mixed bag, a real split decision from the quarter. On one hand, they managed to eke out a win on the bottom line. Adjusted earnings per share came in at 18 cents, which, just barely beat the 17 cents Wall Street was looking for. But, and this is a big but, the real story, the one that everyone's focused on, is that top-line revenue number. And that's where things get, well, a lot more concerning.
And this visual just drives the point home, doesn't it? You've got this tiny little positive bar for the EPS surprise, but then boom, look at that massive negative bar for the revenue miss. It's completely overshadowed. And this is exactly the kind of thing that makes investors nervous. I mean, profits are great, we all love profits, but you can't just keep cutting costs to get there. At some point, you need sales, you need growth, and that's the big red flag here. So let's put a hard number on that miss. They brought in $47.6 million in revenue. The problem? The consensus was around $53.5 million. That is a huge miss, almost 11% short. And look, for any company that's a problem, but for a company that's trying to sell a turnaround story, this top-line weakness is pretty much the worst thing you can report. It's the central issue, period.
Okay, so you've got this ugly revenue miss. How does management handle it? Well, let's get into their side of the story, because they're painting a very different picture.
The CEO, Steve Fife, he gets on the earnings call and basically says, hold on, I want you to forget about this quarter for a second. This was a transformational quarter for us. So right away, he's trying to shift the focus. He's not talking about the miss, he's talking about the future, and specifically this big acquisition they made called LoveBiome. The entire narrative is that this is the key that's going to unlock everything.
And they really hammered home how quickly they're moving on this. Look at the timeline. The deal for LoveBiome closed on October 2nd. For the rest of that month, they were running on separate systems. But by November 1st, less than a month later, they were fully integrated onto one platform. The message they're trying to send to investors is pretty clear. Hey, that big execution risk you were worried about, it's already done. We've handled it. It's in the past.
So the next logical question is, where's the growth actually going to come from? Well, they're basically pointing to this three-part cocktail of catalysts that they expect to kick in during the second half of the year. You've got the new revenue from LoveBiome finally hitting the books. You've got some seasonal tailwinds for their GLP-1 weight management product. And on top of that, they're launching a whole new product line called Healthy Edge. That's the game plan. And this right here is probably the most important slide in management's entire presentation. Despite that really soft Q1, they are standing by their full-year guidance. They are not backing down one bit. So they're telling the market, yeah, Q1 was rough, but we are so confident in our plan, in LoveBiome, and our new products, that we still think we're going to hit these numbers for the full year. That is a really bold statement of confidence. So that's management's story. The big question is, did the market buy it? The short answer, not really. And this really gets to the heart of the disconnect, right? You've got two completely different stories being told. On one side, you have management talking about transformation, growth, and the bright future. But on the other side, you have the market. And the market is looking at the here and now. They see execution risk. They see declining margins. They see the problems that are right in front of them, not the promises of tomorrow. I mean, you don't even need to read the analyst reports. Just look at the stock chart. The performance tells you everything you need to know. Over the last year, Lfvn is down a brutal 46%. And look, it's not just that the market is up. The S&P is up 17%. Their own sector, consumer staples, is basically flat. So they are dramatically underperforming everyone. It's just ugly. And if we zoom in on the earnings release itself, you see the same story play out in miniature. The stock sold off heading into the numbers. Then, after that confident earnings call from management, you got this little flicker of hope. A one-day bounce, but it didn't last. That optimism just evaporated, and the stock has been drifting lower ever since, right back down near its 12-month lows. It's a crystal clear sign that investors are still very, very skeptical. And then there's this. This is the real kicker. The short interest is sitting at around 20%.
Now let's be clear about what that means. That means that for every 5 shares available to trade, one of them is being used to bet against the company. That is an enormous amount of negative sentiment. It's not just skepticism, it's a huge, high-conviction bet from a big chunk of the market that this whole turnaround story is going to fall flat on its face. So, you put it all in the pot. The weak quarter, management's big promises, the market's total disbelief. What does it all mean? Here's our take on where things go from here.
So really, where does LifeVantage go from here? It all boils down to one simple question. Who's right? Is management's optimism going to pay off, or is the market's skepticism the right call? This is the definition of a classic show-me story. The time for talk is over, now they have to deliver.
And you can make a really compelling case for both sides of this trade. If you're a bull, you're looking at this and saying, wow, this stock is cheap, trading at just 8 or 9 times earnings. You've got clear catalysts with LoveBiome, and with that massive short interest, any good news could trigger an epic short squeeze. But if you're a bear, you're looking at the history of consistent revenue misses, you're looking at the margins getting squeezed, and you're saying, this is a show-me story with a ton of risk. Both sides have a point.
So where do we land on this? Well, given that push and pull, the high risk but also the high potential reward, we're calling it a market perform. The story is definitely intriguing, you can't deny that, but there's just way too much uncertainty right now to be bullish. They absolutely have to prove they can execute. Until they do, it's hard to see the stock getting a higher rating.
Now that being said, for those of you with a higher appetite for risk, there is an interesting way to play this. You could look at a long-dated, out-of-the-money call option. Think of it as a low-cost lottery ticket. You're making a bet that the stock will go up, but your risk is capped at what you pay for the option. Why do this? Because if management does pull it off, and that 20% short interest has to run for the exits, this stock could move up, and move up violently. And this kind of strategy is designed to capture that exact scenario.
And of course, we have to say it. This is for informational purposes only. It is absolutely not financial advice. Please make sure you do your own homework before making any investment decisions.